This is Matthew from Commercial Deal Junkie, and I'm going to be going over the difference between the single tenant versus the multi-tenant triple net asset class. Now, I'm going to be focusing mostly on retail, but this can be applied to industrial and as well. So, quick background about myself. I am the principal at Superior Capital. We buy value add commercial property all over the country. We're currently in Kansas, Texas, Florida, and Ohio. I'm also a broker based out of Southern California, where I help investors buy single tenant net lease or multi tenant triple net assets all over the country. All right, so we're going to dive straight into it. The multi-tenant triple net asset. So the multi-tenant it's just like it sounds. You have multiple tenants that are each paying triple net, their portion of the triple net. And this is more commonly seen in strip centers, which is the easiest example for the multi-tenant triple net. Strip centers are all the rage right now. They're also what we're buying at Superior Properties. So this is a perfect example of the kind of things that we buy and why we buy them. But there are cons. Every asset class, every type has its pro, has its cons. Okay. So the pros, number one, you have diversity of income. You have multiple tenants. So if you have a 6 unit strip center and then you have one tenant leave, then you still have five other tenants paying rent. It's another argument for why you want an apartment building versus a single family home is that, a tenant leaves in the single family home, your revenue drops to zero. You have the same issue in single tenant, triple net, which we'll go over in a minute. The other thing is strip centers have more value add potential. Typically, when you're buying a single tenant net lease, you're paying for the lease, you're paying for the tenant. When it comes to multi-tenant, you may have vacancy, you may have tenants that are paying far below rent, they're on shorter leases so that you can go in and you can really play with the leases. You can kick out low paying tenants, take the rent to market, and really upgrade the center and really add value, make yourself, huge increase in your equity if you play your cards right with a multi-tenant triple net. Now, some of the cons are it's definitely more management. Okay, first of all, nothing in real estate is passive, but multi-tenant is definitely less passive than single tenant. So it's not like an investment is active or it's passive. It's really like a continuum. Nothing is completely passive, but it's kind of like it's, somewhere in the middle. Now, multi-tenant triple net is definitely more on the active side. There's more management because you have all these multiple tenants. You're going to run into issues. I have tenants reach out to us about, parking, and they're having issues with the tenant about parking, or one tenant, maybe it's a smoke shop and they're, smoking inside the unit, which causes issues with the nearby tenants. So there all these issues can arrive when you have multiple people sharing the same building. You also have more leasing work because you have shorter leases, you have more tenants, you're going to have to lease the spaces more often. Typically in multi-tenant retail, you'll see 3 year, 5 year, maybe 10 year leases on like a credit tenant. But typically I'm seeing mostly between 3 and 5 year leases, especially on the local tenants. So you definitely have higher turnover, which means you're going to have to hire a broker and you're going to have to pay leasing commissions. So it's less predictable, the revenue on the multi-tenant, but you have more opportunity to increase the value of the building through getting better tenants and making sure you're collecting triple nets. So along with higher turnover, financing is also trickier because there's so many moving parts in a multi-tenant. You have multiple tenants, and then what you have is something called the WALT, which stands for the weighted average lease term, the WALT. That is the remaining lease term for all your tenants based off their size. So if you have, a one tenant that's occupying a whole bunch of space, but they only have 1 year left, and you have a tenant next to them that's occupying a small amount of space, but they have 10 year left, you're still going to have a low WALT. WALT takes into account how safe is this asset, how much term is left on these leases. Another thing is tenant credit. You tend to have lower tenant credit with the multi-tenant assets. That makes it harder to get financing. They tend to trade at higher cap rates, and there's a bit more due diligence that goes through with the lenders. The last thing that kind of goes back to this more management point is that you pay triple nets and you get reimbursed for it. So the tenants don't pay the property taxes directly by going to the county's website and paying them. You actually pay the county's website and then you charge the tenants through the triple nets on a monthly basis. And then you have to do CAM reconciliation when you're done, which is, I'll probably make a whole nother video on that. When it comes to reconciliation, you actually have to make up all the funds. You have to figure out how much were the actual triple net expenses versus how much did the tenant pay. And then you got to figure out, do I need to charge them an additional amount for the year that just passed? Or did they overpay and I need to reimburse them? So that's all extra work you have to do. compared to the single tenant net lease space, which we'll go into in a moment. So multi-tenant triple nets are best for active investors. If you have the capacity and you have the time to learn the business and be actively involved in the day to day, you don't have to be at the asset. I mean, we buy assets all around the country and we don't, we're in Southern California. You don't have to be at the asset, but you're likely going to get more calls. You're likely going to have to work more with brokers to get spaces leased. You're going to have renewal conversations every few years. It's not passive by any stretch of the imagination. It's also good for value add investors. If you're looking to buy something for one price, stabilize it over 2, 3, 5, 7 year period, and then sell it for much more than you purchased it for, that's what multi-tenant's for. Now it comes at a cost, comes at a time cost and a capacity cost, which is the next point. So you need more capacity. So you typically have more of an opportunity to grow your equity, but it's going to take more time and energy from you. And you also have less predictable cash flows because of the tenant turnover, because of the vacancy risk of having multiple tenants. All right, now let's go into the single tenant net lease, which is people love single tenant net lease. Why? We'll go over that in the pro section in a moment. First, let's go over what is single tenant net lease. So the single tenant net lease is one tenant occupies the whole building. They pay base rent, plus they pay all expenses. An example is, Starbucks, CVS, Advanced Auto. They don't actually own their buildings. They lease their buildings and they pay all expenses. Now, one of the biggest difference here is they actually pay their expenses directly. Typically, you'll have a Starbucks go through to the county's website and pay their property taxes directly to the county. They will be the ones to set up insurance on the building. It's not like you set it up, you pay for it, and now you're collecting it from them. Now, it can be like that, but even if it is like that, it's also much easier because you just, this is my tax bill, pay me this. That's it. So the pros are you have one lease, one check. So you have really predictable cash flow. Starbucks pays you 10 grand a month. On the first, you're going to see 10 grand deposited into your account. It's simpler, really easy. And that brings me to my next point. It's way less management. Triple nets are typically paid directly. The tenant is responsible. If there's any issues, any leaks, you also have what's called, in many cases, absolute triple net. So the tenant is responsible for literally everything. In multi-tenant, sometimes that you'll still be responsible for the roof or the structure or the parking lot. So you'll still have major CapEx repairs every, 3, 5, 10, 15 years. But with single tenant, they are responsible for everything. The leases tend to be longer too. They tend to be 10 to 25 year leases, sometimes longer, sometimes a little shorter, but typically they're within that range, and they'll have slight bumps during those ranges. But typically, what the revenue is going to be like for the length of the lease. You have much easier financing. So you tend to be able, if you go to a bank and you're trying to buy CVS and the CVS still has 20 years left on the lease, you can go to, CVS might not be the best example right now because, they're struggling. But if you have a location where you have a credit tenant with 10, 20, 30 years left on the lease and you take that to a lender, they love financing those. Those are considered lower risk financing for them. You also have lower cap rates. Now, that's kind of a pro and a con. I kind of put it in both categories. This should probably be a con here, but the reality is they trade at lower cap rates, sometimes as low as 3 or 4, sometimes as high as 6 or 7, sometimes 8. It really depends on the quality of the tenant. You are heavily dependent on the tenant. So what's the cons? The cons are you only have one tenant. So if that one tenant leaves, you're at 100% vacancy. You go from, making X amount a month to losing a bunch of money every month because now you have to pay property taxes, you have to pay insurance, security, you have to make sure the building is, secure. And now you have to go out and hire a leasing broker and go out there and lease the space. And during that time, you are absolutely bleeding. So the value is also tied to this tenant. So for example, a Starbucks, you buy it for $2 million, but it might cost less to build one down the road. So if Starbucks leaves, your building is worth significantly less. Typically, it's worth significantly less than what you paid for it. Why in many cases you want to be careful that there's a lot of term left on the lease, there's healthy bumps, that tenant, or not just the corporation, but the operator, because Starbucks is franchised. So you want to make sure that the franchisee is also a strong franchisee with a strong balance sheet, because the Starbucks might not go out of business, but that franchisor might go out of business. So there's a lot more risk than people like to admit with a single tenant net lease, I actually have a whole video that it's gonna be up here somewhere where I talk about the risks of the single tenant net lease space. Because if that one tenant leaves, I mean, buildings are worth significantly less than people pay for it, and you can lose money. There's also limited upside. Typically, by the time you buy the building, you're just gonna have slight bumps all the time, and then the building is not going to be worth significantly more unless you know that tenant renews at a much higher rate, or you're able to replace the tenant with another credit tenant at a much higher rate. So typically there's limited upside. And then the last con is retenanting just takes longer, especially with the larger the spaces, the longer it will take to retenant. Location also has a lot to do with that, how much traffic is on the road, but retenanting can be a problem. So in order to buy, now, if you want to limit the risks, you just have to do the opposite of these when it comes to the cons. You want to make sure that you have a strong tenant with long leases. You want to make sure that the rent bumps are healthy and are actually going to match inflation. You want to make sure that it's going to be easy to re-tenant in the unfortunate situation that the tenant does leave. So who's this best for? These are best for people that want to preserve capital. Single tenant at least is more preservation of capital. Multi-tenant, triple net is typically for growing capital. And single tenant net lease, you'll commonly hear it referred to as STNL, single tenant net lease. So if you hear me say STNL, or you hear someone in the industry say STNL, you know what they're talking about. This is probably as close as you're going to get to like a truly passive investment. Now, like I said, nothing is truly 100% passive. This is probably as close as you're going to get to a passive investment. Likely, these are credit tenants that are just going to send you your money every month on the first. It get deposited into your account. They'll take care of property taxes, insurance, maintenance, landscaping, all that. Next, this is also great for 1031 buyers. Someone made a lot of money in an apartment building, made a lot of money in a multi-tenant triple net property, and then they're getting closer to retirement. Maybe they have less time, less capacity. What they do is they 1031 into the higher attention needing asset, the higher capacity asset, into something that runs more passively and just deposits money into their account every month. So what you commonly see is that people will start their journey with the multi-tenant triple net leases and then graduate into the single tenant net lease space. So people typically, you'll see them later in their life as they've built up a healthy portfolio, or high earning W-2 people that don't have a lot of capacity. They'll go out and they'll buy single tenant net lease assets for the depreciation, and because they have to do absolutely no work, they just receive the deposits every month and they don't have to worry about it too much. So that right there is the two major difference between the single tenant and the multi-tenant space. Deciding which one for you is really a personal decision. A lot of people are like, why would anyone do single tenant at least? Lower cap rates. It's hard to grow the money, but it really depends on where you are in your life. If you're a really high earning physician that's working 70 hours a week, you probably shouldn't be buying multi-tenant triple nets unless you have a team or something that you can build to help you manage it. Now, if you don't have a lot of money early in your career, you're trying to grow your capital, you should probably stick with a multi-tenant, so that you have the opportunity to really grow the asset, grow the value of your money, and have a successful exit one day, possibly into a single tenant net lease through a 1031. So that's kind of the gist of things. I hope you guys enjoyed the video. Let's connect. So is my website, my phone number, if you want to talk. And I could talk real estate forever. So if you guys want to just get on the phone and talk about a specific deal you're looking at, we can chat about that. Feel free to shoot me an email. But yeah, let's connect. I hope you guys enjoyed, and like, subscribe, do all that stuff, and I will catch you guys on the next one.